Pratik Gupta is with us, Chief Executive Officer and Co-Head at Kotak Institutional Equities. Pratik, it's always a pleasure having you with us here. Good morning. Thanks very much. Prashant this side. You know, we had a bit of a break with these stake sales. Large investors, private equity, VCs, promoters, but well, that's back. Back and how? And last week was big. The week before that was big. What's going on, Pratik? And you know, we are, just to differentiate this, a lot of MNC promoters are also selling, right? Which is it's picked up quite a bit. I think it started with Timken, but we've had 2 or 3 more transactions since. Your thoughts?
Hi, good morning, Prashant. Thank you for having me here. Yes, you're right. We've seen we will probably see more of these stake sales coming through. Typically, what happens is during the earnings period, which is usually the 15th of Jan to 15th of Feb, typically, a lot of the sellers are insiders. These are either promoters or private equity funds with board seats. So they typically don't sell at that point in time. Also, investors are quite distracted with looking at their own portfolio companies with the earnings season going on. So typically what happens is after the earnings season every quarter, you do tend to see a resumption of stake sales coming through. So this quarter is no major surprise as such. On the MNCs selling their stakes, I think it's very company specific. For example, both in the case of Whirlpool, BAT, etc., it's also a little bit to do with the issues at the parent. The local unit is trading at much higher valuations, so opportunity to monetize, and the market is buoyant, so that kind of supply can get absorbed. So those are the kind of issues over there. But generally, yes, we are seeing more stake sales come through. And that in some ways it adds more liquidity to these stocks, which they may have a lower free float, so that helps in terms of overall liquidity. But I think from investors' perspective, longer term, they need to look at the fundamentals of the company and not get too hassled by these stake sales by promoters. They may have very different intentions and very different time horizons versus investors who are buying the stocks over here.
Okay, interesting. Well, Pratik, hi, good morning, and thanks a lot for joining in. So let's talk about where there is potential in this market, right? Because that's the one thing that everyone is struggling with, to find growth as well as value. It's just become such a tough market to find good valuations. Where do you see potential now over the next 1 to 2 years?
So you're right. I think most investors are struggling on the valuations where they are right now. India's Nifty at 22,200 is currently trading at 20.5 times 1 year forward earnings, which is not cheap by any stretch of the imagination either, versus India's own trading history, whether you take a 5-year period, 10-year period, 15-year period. Or when you compare with the likely growth ahead, we think growth is slowing down. FY24 at Kotak, we are expecting the Nifty to grow earnings by about roughly 18-19%. But we think over the next 2 years, the growth will slow down to about 12% on average. Again, if you put yourself in the shoes of a global investor, again, India looks quite expensive compared to, say, a China or some of the other Southeast Asian markets. Now, granted that in China, there are policy risks and there's greater uncertainty, but nonetheless, the valuation gap and the price performance has been very stark in the case of India. So we are seeing a lot of global investors struggling with buying stocks in India. In fact, they're just holding on to what they have. We're not seeing too much of fresh inflow. That's also reflected in the year-to-date foreign selling data on the cash market. They've been net sellers to the tune of roughly 50,000 crores from 1st Jan till last Friday. And the local funds, they are seeing inflows, therefore they're investing. But even they, when we speak to them, are really struggling with the valuations right now. And it's more of a, I guess, just being a bit more opportunistic here and there. But if just to go back to your question, the areas where we think there is still some value left is perhaps still the banks, which have done well, but not as well as the broader market. Banks and insurance companies are still trading below their pre-COVID valuations 4 years back. So we think that's one area, that's the only major area which stands out. Then obviously there are other areas like, real estate or high-end consumption in the form of luxury hotel chains and so on. But amongst the large sectors, I would say it's only the banks and maybe the life insurance companies.
Right. Hi, Pratik. Morning. Good to see you in. Nigel on this side. Within banks, what would you like at this juncture? Private sector banks or public sector banks? Both of them have moved in opposite directions, actually. So at current reckoning, what do you like? And also, you had a conference, right, last week. What are the key takeaways? Couple of points.
Okay, first on the banks, we continue to like the large top 2 or 3 state-owned banks. The main benefit over there being, despite the strong price performance, valuations are still attractive. But keep in mind that we're running in a very tight liquidity situation. Deposit growth is tough. The state-owned banks have a very strong deposit franchise, and that enables them to garner deposits quickly to meet the credit growth requirements. So we like the top 2, 3 PSU banks, but equally, we still like the 3 or 4 top private banks. Although I must highlight that in the short term, given the ongoing tight liquidity situation, we do expect to see slightly weaker earnings growth for the bank sector as a whole in the March quarter and the June quarter in the short term, because loan growth is slowing down, NIMs are coming under pressure, and the best of the low credit cost period is behind us. So from now on, credit costs will only inch up slightly. It's just that the overall valuation versus the rest of the market still looks relatively attractive compared to other stocks in other sectors where either the stocks have gone up quite a bit and valuations are getting looking quite expensive. Now, coming to your question about the conference, yes, we had a very large turnout at our annual investor conference last week in Mumbai. We had 1,000+ institutional investors, and I think more interesting was this time the increase came more from the foreign institutional investors. We had, if I remember correctly, roughly 250 institutional investors from all over, from New York, London, Singapore, Hong Kong, etc. And many of them came with large teams. Some of the large global long-onlys came with large 18, 20-member teams. And we had a very wide variety, from sovereign wealth funds to long-onlys to boutique India-dedicated FIIs to hedge funds and so on. But I think one overwhelming message that we came through, which ties in with what I just said earlier, there is a lot of interest in India. Everybody is trying to come up to speed and improve the knowledge about various sectors and stocks in India. Many of them were coming for the first time or coming after many years. But there is not an inclination to buy India right away. Almost everyone likes the medium-term story, but they find valuations a bit challenging.
Okay, all right. Just one final word from your end on some of these spaces that have been doing pretty well in the last 6 to 12 months, right? Whether it is the electric vehicle space, the renewable energy space, defense PSUs have been doing very well. Any of these themes that you still like, where there could be follow-on buying despite valuation discomfort?
So I think in the renewable energy space, yes, that's a growth area. So all of these spaces actually, fundamentally, we like these. These are the long-term sort of growth stories. But I think it's also, you have to go back and look at them literally stock by stock. In some cases, let's say the PSU defense companies, we are a bit cautious in the short term, despite a very positive long-term view. So it depends on the investment time horizon. In the next 2, 3, 4 months, we would be a bit cautious. Perhaps if these stocks stagnate or correct a little bit, we may become a bit more positive. Although from a longer term perspective, 3 to 5 year view, we're still very positive. EVs, I think there could be a little bit of a slowdown in the short term, government subsidies being withdrawn, more competition coming in, the incumbents coming back with their own models and launches and, getting new technology, etc. But again, it depends on the company, which sector, two-wheelers versus two-wheelers, we're relatively, EV two-wheelers, we would be more positive compared to the others. And so on. So it's really stock by stock. But in general, I would also look at the incumbents in these spaces where you would be a little bit more cautious.
Okay, all right. Thanks a lot for joining in, Pratik. Appreciate your thoughts here on CNBC TV18.